Good morning, everyone. Welcome to a very special credit management webinar, Creating Successful Terms Pushback Outcomes. Well, before we introduce Scott, I'd like to remind you to take the opportunity to engage us by using the question and answer box. It's located in your WebEx toolbar. We are going to try and answer your questions following today's presentation. If we don't have time for questions at the end, however, we will make every effort to answer your question directly. Scott is a renowned legal expert, and he's written prolifically on the topic, so please take the opportunity to get your questions in. If you would like a copy of today's slides, we will be sending out a link following the presentation today, including a link to the playback of the webinar recording. Scott Blakeley is the founder of Blakeley LLP, where he advises companies around the United States and Canada regarding creditors' rights, commercial law, e-commerce, and bankruptcy law. He was selected as one of the 50 most influential people in commercial credit by Credit Today. He's contributing editor for NACM's Credit Manual of Commercial Law, contributing editor for the American Bankruptcy Institute's Manual of Reclamation Laws, and author of A History of Bankruptcy Preference Law, published by the ABI. Credit Research Foundation has published his manuals entitled The Credit Professional's Guide to Bankruptcy, serving on the Creditors Committee and commencing an involuntary bankruptcy petition. Scott has published dozens of articles and manuals in the area of creditors' rights, commercial law, e-commerce, and bankruptcy in such publications as Business Credit, Managing Credit Receivables and Collections, Norton's Bankruptcy Review, and the Practicing Law Institute, and speaks frequently to credit industry groups regarding these topics throughout the country. He's a member on the board of editors for the California Bankruptcy Journal and is co-chair of the subcommittee of Unsecured Creditors Committee of the ABI. Scott holds a BS from Pepperdine University, an MBA from Loyola University, and a law degree from Southwestern University. He served as law clerk to bankruptcy judge John J. Wilson. He's admitted to the Bar of California. And now I would like to turn things over to Scott for today's program. Scott.
Gary, thank you for the introduction. Everyone, welcome to a topic that I hear from so many credit and finance teams of this threshold question of who controls our trade terms. And what I've heard from credit teams over a number of years, and what's reflected in the statistics of several of the slides that we'll be working through, is that we're finding more of our customers dictating to the credit teams of the suppliers of the supply chain what the trade terms, and then indirectly what the credit lines should be with those customers. And so our mission today is to educate not only the reality of what we're finding with more of our customers demanding extended terms, but asking the question, what can we do as suppliers to customers, even those customers that our management may view as indispensable, but is there a principled response that the credit team can offer, whether it's through the sales and management of our organization or directly with the customer, to try and keep that customer as a normal terms customer. And so with that overlay, let's appreciate with some humor, and this is slide is for that. It says if an invoice is due in 30 days, we pay in 60, something that we're experiencing more and more. We might call that our informal terms pushback, and we will make a decision tree evaluation from our customers that are making that informal demand versus the formal demand. But further to that point, if it's due in 60 days, we pay in 90. If it's due in 90, then they probably won't need the money anyway. And that's our customers' finance team, their CFO in particular, that may be making those statements to the supply chain overall. But what this underscores is the mission of so many of our customers, whether the small or mid-size, or even our national accounts, companies that may be publicly traded, that have this mandate to try and improve their cash flow and working capital. And consultants that are advising these companies often are saying one of the ways to improve the metrics to measure your metrics such as cash conversion cycle is by moving the supplier's terms from normal to extended. What this slide also is a reminder for is the slippery slope that many suppliers ask as a threshold, and we often see this raised from the credit team's perspective, is if we do have a position where we can negotiate with that customer and that demand for extended terms, let's say that it's from 30 to 60 days, are we going to face another demand from that customer a year or 2 years from now, making that 60-day extended terms customer 90 days or 120 days? And then tied to that, and again, part of this is an education with our credit, from the credit team side to sales to management, is if we agree to that demand from that particular customer for extended terms, are we opening the door for extended term demands from other customers as well? And so with that, our next slide is to appreciate the value that suppliers bring to our U.S. economy, and appreciate that we have multi-billions of dollars in trade credit extended every day. And one of the key points that our customers have found, especially since 2008, is that suppliers are a cheap date. They are far less expensive than traditional financing sources that the customers may lean on, such as money center regional banks, asset-based lenders. Far easier to extend the terms of suppliers to improve their working capital than call on a lender for those same financing needs. But in terms of a history lesson, appreciate that the topic of terms pushback, whether formal, whether informal, really came to be in 2008. And that impetus was more that our customers' traditional sources of financing simply had moved away as a result of the downturn in the economy. And that was a key point in which so many customers look to the supply chain to assist them in working through their financial difficulties. Now we move forward to today, and the bullet that is a reminder for so many credit teams is this dilemma that they face, because many of our larger customers that we're supplying are sitting on record cash holdings. But having said that, part of their strategy, our customer strategy, is to say we're still interested in moving our supply chain to extended terms. So again, moving away from 2008, where there was the financial need by our customers to move suppliers to extended terms. Instead, with so many of our larger customers today, it's really being driven by metrics, some of which we'll be working through in a few minutes. But it's a reminder for us that vendors, in effect, become working capital lenders. And again, that's part of the tension that the credit team has to work with our sales team and our management in responding to these demands for extended terms. And it's an appreciation as well that we as suppliers of goods have perhaps the biggest cash drain on our customers' purchasing needs. And again, as a consequence, why so many of our customers are demanding extended terms. And then the final bullet of this slide is also a reminder for us that it has now become a customer's best practice to attempt to move the supply chain to extended terms. This chart is a reminder of the world that so many credit teams are now living. This does not drill down to the customer size, but the overall reflection that more of our customers, again, whether we phrase it as requesting versus demanding, really depends on how valuable we are as a supplier in that customer supply chain. But the reality is the demand for extended terms is not slowing. And in terms of reporting responsibilities that we have to our management is the expectation that this increase in demand for extended terms will only increase in the coming years. And so we ask ourselves, what are the ways in which our customers present to us their request or demand for extended terms? And so we have in this slide an example of one customer, a national account, that has demanded extended terms from the supply chain. And I think it's instructive for us, number one, to see how this is presented to the supply chain. So this is what we call a formal request for terms pushback. And with that, it may be an email that's sent out to the supply chain. It may be a posting on the customer's website. But it's an announcement on the one hand that recognizes the value suppliers bring to the customer. But it's also a recognition that the customer has operating expenses that have increased, and as a consequence, they need the assistance of the suppliers acting as partners to agree to move out their trade terms to assist that customer in meeting its operating obligations. I think one of the interesting points in this announcement, which is reflected in so many of the national accounts we may sell to, is part of the justification to support this demand for extended terms is this customer saying, our competitors, and this is a retailer that's making this demand, have moved their supply chains to extended terms. And so for us to be competitive with our competitors, we must move you to extended terms. It's the phrase of benchmarking that we see justified, especially with our national accounts. So let's ask ourselves, what's a principled approach when facing this demand for extended terms? And so the purpose of this slide is to raise that threshold question from the perspective of the credit team. Customer strategy of extended terms with this question or inquiry that we make as credit team and finance team members with this decision tree of financially sound customer, struggling customer. And what that requires of the credit team is to rescore the customer, especially for our small and mid-sized customers whose financial information is not publicly reported, who may stake out the position that suppliers are not entitled to our private financial information. But it does raise this question for us as credit team members, is the demand by this customer one, not to improve the metrics that we'll be working through, but instead, if we simply don't agree, especially if we're deemed a key supplier to this customer, that the customer may not meet its operating obligations. And again, so for reporting responsibilities that the credit team has to sales to management, is that we're looking to rescore that customer, reevaluate that risk where you may feel comfortable with normal terms of 30 days, but if the customer were to succeed in its demand for extended terms, let's say 90 days, and let's imply from that 90 days that you're tripling the credit line with those extended terms, what's that evaluation look like in terms of your reporting responsibilities to your sales and your management as well? So again, the mission here is that the credit team getting its arms around just what the risk factor is tied to the demand for extended terms. We're also going to talk about margin erosions, which is, again, a key driver that we're finding with so many of our national accounts, and what the role of the credit team is on that. The second bullet in this slide is this idea of formal versus ad hoc. And so we gave an example in the prior slide of that formal demand for extended terms. And again, we often see that tied to our national accounts. The ad hoc instead may come through, let's say, our sales team, where a sales team reports to the credit team saying, customers come to us, we need to move our normal terms relationship to extended terms because, and you can fill in the blank as to that, because oftentimes our sales team in this ad hoc or informal terms pushback request is one where the customer's reporting to the sales team that one of your competitors has moved this customer to extended terms, and so to accommodate the customer's demand that we meet our competitors' extended terms, that we accommodate that request. But again, part of our evaluation is in this ad hoc context, as credit team members, are we being singled out? And so we often see the value of industry groups highlighting as a sounding board the response that a supplier may have in this ad hoc approach. And again, this is assuming that we have leverage in the relationship to simply say no, because we often find, even in the formal settings, that our sales team may essentially be an advocate for our customers, saying if we don't accommodate the customer's demand for extended terms, we're going to jeopardize this trade relationship. If the sales team's view is that we can be easily replaced as a supplier, the consequence is if we don't agree to that demand for extended terms, well, we'll simply be moved out of the supply chain. And so again, part of our due diligence as credit team members, especially when we drill down to this ad hoc or informal demand for extended terms, is what are industry group members doing? Had they been approached? And so what I suggest in terms of the due diligence at this point is reaching out to those industry group members with the threshold question, have you been approached by this customer demanding extended terms? So you appreciate as to your reporting responsibilities that we are or are not being singled out for this extended terms demand. And so part of our evaluation under the ad hoc terms pushback strategy is, again, a sounding board from industry group members who are your competitors, who are also selling this customer, for you, the credit team, to get a better bead on whether you're being singled out for that demand for extended terms. Now, this is where we appreciate that there is some antitrust overlay in the U.S. Regarding the evaluation for the customer's demand for extended terms. So on the one hand, my view is that we can approach competitors who are industry group members as to whether they've also been approached by this customer demanding extended terms. But it is your decision, your meaning the credit team, again in collaboration with your sales and management, as to whether you're going to agree to that demand for extended terms. What we can't do with those industry group members who are competitors is collectively agree to refuse that customer's demand for extended terms. It's a decision that each supplier has to make on that front. And again, the uniqueness of these formal versus ad hoc types of requests, again, often are driven by the size of the customer that we have. Part of the questions that we as the credit team have reporting to our management and our sales team as to why we're seeing so many of our larger customers demanding extended terms really turns on some key metrics that our customers are measured by, our customers' finance team is measured by. Perhaps the most important metric is what we call cash conversion cycle. And this is a metric that looks at the number of days it takes to convert, let's say, our product, our inventory that we've sold the customer on terms, into cash. And so our customer's mission is to extend the supply chain terms out far enough that they will have converted your product to cash by the time your invoice is due. And this metric is one, especially for our publicly traded customers, is one that may be a key driver for our customers demanding extended terms. Likewise, days payable outstanding is a metric that we see our finance team also using as a justification to support moving the supply chain to extended terms, as is days inventory outstanding. Those three metrics, especially for our large customers, are the drivers to move the supply chain to extended terms. And the takeaway for us on the credit team side is that with these larger customers, it's less about, or perhaps not even existent to, credit risk, and more about metrics from our customers' finance team side that is the driver of that. Conversely, if we were to drill down from the supplier side, the DSO, Day Sales Outstanding, this is a key metric as how the credit team is measured. And of course, if that customer is successful to moving us to extended terms, our Days Sales Outstanding erodes as a result of the customer succeeding in moving us to extended terms. So it is an appreciation in terms of how we as credit team members are measured, of what the impact can be as to our success in moving that customer to extended terms. The next slide that we have is a question of how do we respond, and that response is often, as reflected in these statistics, is one of a team approach from the supplier side. If we're a company that controls our supply space, we're in a position to say no to virtually every customer's demand for extended terms, then we often see it's exclusively the voice of the credit team to reject that request for extended terms. The reality is most suppliers are in a competitive marketplace, and as a consequence, we have, we'll call it a team approach in response to the customer's demand for extended terms. And I've seen many suppliers who are facing multiple requests or demands for extended terms have set up what they call a TPS team, and it simply is representative from functions from credit, from finance, from sales, from management, and they simply get together with each demand for requests for extended terms and evaluate the merits of each request. And the statistic of roughly 63% approaching it in a fashion of evaluating the merit of each request is what's borne out from the supplier side, which then leads to our next question of who actually approves these requests for extended terms. And traditionally we think request for terms, that's a credit function, although again I appreciate the sales in some organizations have a voice in this process. But when we move to extended terms, this slide is a reflection of the voice of many other parties tied to the relationship. And so what I see in terms of a practice of credit teams, especially for those customers our management deems is valuable, is there are reporting requirements. So we'll have the credit team submit an evaluation based on risk, on margin erosion, a number of other factors that we'll be working through, which is then evaluated by the controller, the treasurer, who then will work with the C-suite team as to hopefully a negotiated response to that customer's demand for extended terms. Again, this approach that's reflected in this pie chart is one where that customer is deemed quite valuable, again, based on volume, based on margins. We're not going to see our small customers get the attention of key members of our management on that. The next question is, what are the typical number of days that we see our customers demanding extended terms? I think this bar chart is really industry dependent because I have many manufacturing clients that would say over 60 days, especially for national accounts, is now commonplace. But the appreciation for this is we're seeing, again, a greater demand for extended terms, and I think most significantly, those extended terms keep pushing further and further out. If a normal terms customer for us is 30 days, we may see 90 days as the now more common request, which may then move to 120 days or 150 days. So again, we circle back to this question: what's the voice of the credit team in the face of a demand for extended terms? And so I've set out bullet points to consider. We've raised that threshold question of credit risk, and with that, rescoring the customer. But then we also move to perhaps a less traditional role of credit team members, which is the impact on our margins in this relationship. And so the takeaway with this opening bullet is, if the customer succeeds in moving us from 30 days to 90 days, how does that impact us in terms of managing the margins of this relationship? And so again, it's beyond just a risk management evaluation, but is this maintain a profitable relationship if the customer succeeds in moving us to 90 days? Or does this evaluation, this profit and loss margin evaluation, open the door for a negotiation where customers demanding 90 days, your evaluation of the margin hit is let's move it to 60 days as a negotiating point? That's what this can assist us in, whether it's internally with our sales team, finance and management, or then leading them to the customer as well. And likewise, with the margins, is how does it impact our cash flow? Because if we're, let's say, a smaller supplier, and the cost to finance these extended terms, because our financing may be quite high, again, that is a drag on our cash flow, and again, something we must be aware of, our sales team should be aware of, if the customer succeeds in moving us to extended terms. And then likewise, short-term debt is also an evaluation for us. SCF alternative. This is a question that our national accounts are asking. Is on the one hand, their mission is, based on the metrics slide that we discussed, how do we move the supply chain to extended terms? But how do we also appreciate that we're not going to find our suppliers, especially our small suppliers, suffering because of these extended terms? And so supply chain finance is being proposed at the national account level, and it's being moved downstream as well for our mid-sized customers as well. And so part of our decision tree in terms of the credit team's evaluation for that demand for extended terms is supply chain finance an alternative? And we'll talk about the way in which supply chain finance is evaluated from the credit team as well. And then tied to that is the customer strategic. Again, that's often the voice of our sales team. That's the voice of our management. What is their value in this relationship? And again, the sounding board from our sales team is this customer strategic. And again, from our sales team side, if we don't consent to the customer's demand for extended terms, we're going to run the risk of losing this customer, which again ties to, are we providing an indispensable product or service in this relationship on that front? So again, these bullet points can be used by the credit team in response to a customer's demand for extended terms, appreciating that it's really a reporting function that these bullet points look at in collaboration with our finance team and our sales team as well. And this slide, again, is just a further drill down of what we see with the credit team asking itself and reporting to management in the face of a demand for extended terms, especially for those customers that our management views as an indispensable trade relationship. And so, again, when we talk about the notion of terms pushback, from the supply side, we often, again, as part of our due diligence from the credit team side, is to get a sense of what our competitors are doing in response to the customer's demand for extended terms. And so this slide is, again, a reminder for us that on the one hand, there is the financial evaluation, the margin evaluation that we as credit team members ask. But again, as part of our reporting responsibility to appreciate kind of the competitive nature of the supply chain is, what are our competitors that are supplying this customer? How are they responding to that demand for extended terms? And so the purpose of this slide is a reminder that there are limitations as to the credit team's due diligence as to what the competitors that are supplying this customer can do to gather that information. And the takeaway for us is we simply can't have an agreement with our competitors in response to this customer's demand for extended terms. The Sherman Act, which is a federal antitrust law, is intended to protect our customers from what would be viewed as anti-competitive behavior. In other words, suppliers collectively agreeing to refuse that customer's demand for extended terms. Again, we can ferret out and evaluate what our competitors are doing in response to a customer's demand for extended terms, but it's our responsibility as credit team members, again in connection with our finance, sales, and management, to make that independent determination as to whether we're going to agree to extend terms to the customer. So let's add to the mix, beyond just the metrics of our largest customers driving terms pushback. This slide is a reminder as well that if we haven't faced a demand for extended terms, it may be an appreciation that it may be coming. It may be coming because if we see things like a competitor of our customer moving the supply chain to extended terms, then the topic that we touched on, benchmarking, may very well be coming to your customer. And again, it's a justification that we see by our customers saying that we're moving you to extended terms because our competitors have succeeded in moving their suppliers to extended terms. The second bullet is activist investors. We often see this in the context of hedge funds acquiring companies. And these activist investors are not looking just to unlock shareholder value, but also hidden value that they see on this company's balance sheet. And one of those hidden values that can be unlocked is supply chain management. And so their view is, we acquire the company, one of the first strategies that we employ is a terms pushback rollout. And so the takeaway for us is, if we learn that our customer has been acquired by a hedge fund, it's fair to report to your management or your finance team, expect that this customer may be pushing for extended terms. It's kind of the pro forma that we see in these settings. Economic slowdown. There's talk of either a slowdown or recession on the horizon. That may serve as a justification for our customers to try and move the supply chain to extended terms. Economic slowdown, however, also may speak to perhaps greater credit risk. And this is kind of a key point in terms of the relationships, the trade relationships that we have with our customers. Because on the one hand, we appreciate that if the economy is slowing, and as a consequence, perhaps our customers' revenues may also be slowing or decreasing. Does that mean an impact on the customer's margin? Does it also increase credit risk? And so, again, one of our reporting responsibilities for our sales team and our management, either in considering the demand for extended terms or where we've agreed to extend those terms, what's going to be the impact in terms of the risk factor related to an extended terms relationship. And so, again, that's part of what we have to ask ourselves. And whether it's economic slowdown or what we've seen with some of our customers impacted by tariffs, we've seen tariffs also be used as a justification to move the supply chain to extended terms, especially for those customers who are not able to pass the tariff cost to their customer. And so they're reaching out to the supply chain saying, our margins are being hit as a result of these tariffs that we can't pass to our customers. Therefore, we have to justify extended terms because of the hit from tariffs. Customer mergers akin to activist investors, we see this support or justification to move to extended terms. So if your customer is acquired, we often see as part of the financing costs of the acquisition be pushed on suppliers. So again, a red flag, when you learn that your customer is being acquired, don't be surprised that the demand for extended terms may be forthcoming. Supply chain financing move downstream. Again, supply chain financing is an alternative that our national accounts had been offering the supply chain. And now we're seeing the money center banks, the regional banks that are offering the supply chain finance to the largest companies now agreeing to provide that form of financing to the middle market. And so the takeaway is that we'll find more of our customer, mid-size, middle market customers looking to supply chain finance to support the demand for extended terms. And then two other points, the press and the cottage industry. We now have consultants over the last few years calling on our customers' finance team, again, highlighting, unlocking the value of their balance sheets. And one of the easiest ways these consultants underscore and creating that value is by moving the supply chain to extended terms. And again, we also have, for our publicly traded customers, Wall Street pressing these companies, your customers, to move the supply chain to extended terms. And the final bullet is just the international influence. And we find that European companies, for example, commonly have extended terms relationships with their supply chain. So this leads to, what are we going to do about it? What is our principled approach in response to a demand for extended terms? On the one hand, we've talked about the reporting role that the credit team has, whether it's credit risk, whether it's margin management. And so what can we do as a credit team member, finance team member, to preserve this terms relationship? So the purpose of this decision tree is to really work through where we might find ourselves as suppliers in the supply chain, again, with our ultimate mission as credit team members to keep the customer as a normal terms relationship. And so we start with the TPS request or demand, followed with the credit team's evaluation of their ability to pay those extended terms, including with that an increased credit line. And from that, the credit team's voice, again, is let's try and stay on normal terms, which leads to this split, which is often the voice of our sales team saying, do we have a competitive advantage or are we a key supplier? And so let's assume that the sales team prevails, saying we don't have a competitive advantage. Then we go to a split as to what I call an accommodative response. That would be the credit team's DNA. And so we have multiple strands under the accommodative response to the customer's demand for extended terms. And under that accommodative response, the credit team is looking at principles to keep this customer as a normal terms customer. And so by way of example, some of the points that we might use to negotiate and preserve this normal terms relationship is things like can't single out terms in this relationship. So a number of factors that go into the price of our product or a service. Credit terms are one of those, and we're simply not going to agree to allow you to parse out that piece of the pricing of our product or service so you get ultimately a better price for our product. A second point is another federal antitrust law that touches on terms pushback. And Robinson-Patman, we think of in terms of competitive pricing for our product. And the notion under Robinson-Patman is we as suppliers have a responsibility to class our customers. And we class those customers on a number of factors, including region of the country that we supply, the kind of product that they purchase, as well as the volume of that product. And then we class our customers based on those factors. And under Robinson-Patman, the general principle is those customers that we've classed as alike, when it comes to credit terms, the role of the credit team is to offer comparable terms. And if we don't offer those comparable terms to a like-classed customer under Robinson-Patman, then we are, in effect, discriminating against those customers that aren't being offered extended terms. And so this ties to the relationship where, let's say we have, at the national account level, 5 accounts. One of those 5 demands extended terms. Sales team says, we have no choice. We have to move them to extended terms. Credit team, working through that Robinson-Patman evaluation, says, on the one hand, we appreciate the value that this national account brings, and we have done our profit and loss evaluation, our risk evaluation. But the other factor we look at is Robinson-Patman. If we agree to the customer's demand for extended terms, in my example, those 4 other like-classed national accounts should be treated comparably by being offered extended terms. And so what we as credit team members have as a responsibility is reporting not just to our sales team but to our management of what the Robinson-Patman implication can be in this process. So we need to appreciate that part of the evaluation. Now we do have a bright line exception under Robinson-Patman, which may be used by our sales team. And that bright line exception is a competitor of ours, of the supplier, has moved this customer to extended terms. And our sales team's response is the only way to preserve this trade relationship is to meet our competition. And Robinson-Patman says, in that context, if the justification to move this customer to extended terms is to meet an extended terms competitive relationship, then Robinson-Patman won't limit the supplier's right to do that. Now, how does that play into the credit management of the relationship? Well, the credit team needs a principled, justified response to meeting this Robinson-Patman exception, which says that, customer, we're going to need you to complete what I call a meet the competition form. And I can email to Gary, or feel free to email to me the kind of form that we recommend credit team members use as a justification to move this customer from a normal terms relationship to an extended terms relationship based on your competition. But with that kind of form that the customer completes, highlighting that your competitor has offered extended terms, then I would feel comfortable as a credit team member to support moving this customer to extended terms beyond all the other factors that we've talked about in terms of the credit team's reporting responsibilities. Another basis, again, with this mission from the credit team under this accommodative response header, is to say, can we charge you more for the product or service if we're moved to extended terms? In other words, two price lists, a normal terms and an extended terms price list. And there's nothing under Robinson-Patman antitrust law, there's nothing under the Sherman Act antitrust law that prevents us from offering two price lists based on a terms relationship. The hurdle for us is the metrics, especially for our national accounts that are using to justify moving us to extended terms, don't account for the supply chain increasing the price of their product or service. And so on the one hand, it is a negotiating point to keep this customer either as normal terms or at least maintain the margins in the relationships if we move to extended terms. But having said that, we're likely going to get pushback from our customers' finance team saying, we're not moving you to extended terms to then also see a price increase. But again, part of the relationship that we might consider. Contract controls is something that I've seen suppliers in industries where many of their customers are demanding extended terms. And in this setting, we ask ourselves, do we have a PO-based, invoice-based relationship? In other words, customer places the PO, we fulfill that and match that with an invoice. The trade relationship is complete based on fulfilling that PO. What that opens the door for is, again, the customer's demand for extended terms, and those subsequent POs will reflect those increased trade terms. If, by contrast, we have a supply contract, and let's say that supply contract is controlled by time, let's say through 2020, in that setting, we would say that customer, on the one hand, we appreciate your demand for extended terms. On the other, we've negotiated a contract. One of the key provisions of that contract is trade terms. It's a normal terms relationship through 2020. Until that expires, we're simply not in a position to renegotiate the terms of that contract. Likewise, other points to consider as to pushing back on that customer's demand for extended terms, we may have, through our lender, restrictions on financing an extended terms relationship. And so we may have a loan covenant in our borrowing arrangement that says your accounts receivable that's in excess of, pick a number, 60 days or 90 days, is not going to qualify under our borrowing base, therefore it's ineligible, therefore your cash needs may be limited. And so we see that as a justification by some suppliers saying, on the one hand, we'd like to accommodate the demand for extended terms, on the other hand, our lender simply won't permit us to do so. And we also see that with credit insurance being offered as well, that coverage by the insurer may not extend to an extended terms relationship. we also have, as part of this decision tree where the customer prevails on the demand for extended terms, what can we get in exchange? And so perhaps our management says, well, we want more business. If we're going to be required to provide extended terms and increase the credit line, then we want to be the exclusive supplier in this relationship. And so something to consider on that piece. We may also want to control the payment form, where on the one hand, if the customer is successful in moving us to, let's say, 60 days, we want to ensure that on that 60th day, we're going to be paid. We don't want to hear from the customer, check is in the mail, further pushing out the payment terms. And so we may have an ACH auto pull that when that 60th day comes, we simply pull the payment from the customer's account. And we may also, and this ties to the credit risk piece, ask the question, can we use credit enhancements to assist us in managing the risk of an extended terms relationship? That may come through in the form of, depending on the size of the customer, depending on the customer's balance sheet, whether it's an LC, if it's a product that we're providing, perhaps a purchase money security interest or consignment arrangement. For our smaller customers, perhaps we insist on a personal guarantee. The notion is we as credit team members, where our management says, agree to the customer's demand for extended terms, and that credit team reevaluates the customer's credit risk, including credit terms, then we say we need something more from this customer to manage the risk relationship that the extended terms brings. And then the final consideration of what I call our key supplier response is one of what we might call our traditional credit relationship. And this is the voice of our credit team saying, management has given us the say in response to the customer's demand for extended terms. And so in that setting, the credit team may push back, and if that customer doesn't do what they pledged to do and honor that normal terms relationship by unilaterally pushing out the trade or the terms relationship, the supplier may have the leverage through the credit team to say, we're going to place the customer on credit hold. We may report to the industry group. We may have a provision in our credit application for a late payment penalty. Number of protections that we have available. It's not the traditional approach to terms pushback that we see from the credit team, but it is something available for us where the supplier views the customer as not so valuable, or the supplier views their relationship as having much more leverage in that relationship, and as a consequence, it's what I call the punitive response to the customer's demand for extended terms. This slide is a reminder of how the customer may bind ourselves to that terms pushback. And the takeaway for us here is that if it's an invoice-based relationship and the customer demands extended terms, PO by PO is the relationship. And so we can elect, in the face of the customer's demand for extended terms, to reject future POs where that customer is demanding extended terms. But if we've accepted that PO with the extended terms, knowingly accepted that through the customer's formal terms pushback announcement, then the general principle going forward is the customer is going to stake out the position that we're bound by the extended terms POs. So just be mindful through this decision tree how that plays out. This leads to customer succeeds in the demand for extended terms, and so this decision tree is what I call our customer-sponsored program, supply chain finance versus dynamic discount. These are voluntary programs the customer offers, and we're going to drill down as to supply chain finance in a moment, versus if the vendor rejects the customer-sponsored programs, we have choices. We could factor the relationship, the trade relationship, that receivable that's an extended terms receivable. We can sell the AR. We can hold the AR until maturity. These are all choices that the supplier has. But this slide of supply chain finance is perhaps the most common evaluation we see suppliers, and in particular the credit team, asking themselves, especially for our national accounts. And the way supply chain finance works is, number one, it's a voluntary program. But it starts with this, what our customers call optimizing their balance sheet, which again is unlocking the value of the supply chain by moving suppliers to extended terms. The customer then looks to banks, commonly it's our money center banks, to develop a supply chain finance program. With that program in hand, with the money center bank, the customer announces this terms pushback to the supply chain. This is the formal terms pushback that I've mentioned. With that, the customer then looks to onboard the supply chain finance by convincing suppliers not only to the demand for extended terms, but also to supply chain finance. So our customer and the bank have an agreement. We have an agreement with the customer for the extended terms. Then we turn to the customer's bank that's been designated to offer this supply chain finance. And this is important for us because we have a voice in the negotiation that we have with the designated bank that's offering the supply chain finance. So if I'm from the credit team evaluating what's offered through supply chain finance, I'm asking myself, are there ways to lock in this supply chain finance? I don't want to see interest rates increase and therefore an increased discount that we would take through supply chain finance. So we're going to negotiate with the customer's bank that's offering the supply chain finance to ensure that we have some protection available for us. And again, these are some of the points that we take away in terms of our reporting responsibilities to our management and our finance team. But the takeaway for us, and this slide is a summary, and again, I can email to anyone that requests, but it's to appreciate that we have choices in the face of a customer's demand for extended terms. We can offer incentives such as a cash discount if they pay within, pick a number, 10 days. We'll offer a discount for doing so to keep the customer away from moving us to extended terms. We can also hold that invoice to maturity. We can also move to the customer's voluntary program of supply chain finance. The purpose of this slide, and I have it in an Excel, that you can use to make a calculation, again, part of the credit team's evaluation and reporting responsibilities, is to say, what's our best choice if the customer succeeds in moving us to extended terms? And the takeaway for this slide, in a low interest rate environment, we find that supply chain finance is commonly the most cost-effective way for suppliers to maintain their margins. But the takeaway for us is it is a job for the supply chain to evaluate through this. One of the questions that we have posted is this a webinar more of a purchasing supply chain oriented or customers and credit? I'd say it's both. And we will make this, Gary will make this PowerPoint available to all that would like this. But Gary, we've come to the end of our hour, so I will turn this to you.
So thank you very much, everybody, for your questions. We did not get time at the end to answer them, but we will try and reach out to you directly with the answer to those questions. I want to thank everyone for attending today's session. Thank you, Scott Blakeley, for sharing these insights and best practices with us. When you close the webinar, you'll be taken to a short survey, which we would greatly appreciate you sharing your opinions. And as I mentioned, we'll be sending a follow-up email with a link to the slides and a recording of the presentation so you can watch or share with your team. If you would like more information on Scott's firm, he can be reached at blakeleyllp.com. And of course, you can always reach Experian at experian.com/B2B. And thank you, everybody. You have a good day, and we look for your attendance on future webinars. Thank you so much.